July 10th, 2019, summertime. I hope you guys having a good morning or good day so far. Let's take a look at the markets, which unfortunately are a little bit boring. They are a little bit boring, and there's not too much we can do about it. But let's take a look at them. And we're going to begin with the euro, which is probably one of the most boring things to trade since pretty much a year, unless you really know what you're doing and very good at trading ranges. Now, this is an idea I talked about with you over the last few days, and I said the market is trading sideways, and people probably gonna try to go long at these levels. As you can see here, the market is now stabilized and is trying to trade slightly upwards. But let's not get too excited. Over the last 2 days, which is the beginning of the week, this market has moved with 38 pips, guys. That's true, 38 pips. Let's actually take a look at it. I haven't looked at it for some time, but I did an article about the ATR, so the average true range, and that just shows you the sort of the difference between the high and the low of a specific period, the average, that is. So here's the weekly numbers, and the week here shows that the average range is 130 pip. Now from over the last 14 weeks, that is. Now you can see here, the last time the market was this boring was in August 2014, and then you need to go back to 1985, in December 1985, and that's literally, well, I mean, I was born in 1985 in January, so this is like 34 years, 33 years or so, that this market has not been doing anything. So that's how dull the market is right now. Now, this chart is, it can also show you some very interesting stuff, right? Volatility will come down as it has done in the past, but then after a quiet time or quiet period, you tend to have increased volatility. Now, what's quite interesting is that I published an article on, let me see here, on Investing Cube, and let me just check something here as well. I know we have been having issues with the chat box, that it's not actually working for people. So I'm gonna hopefully should be better now with the chat. But I published this little article yesterday. Actually, yeah, yesterday. It's called, in essence, is the probability of a recession in the U.S. and 12 months from now. So according to this model, which is derived using the Treasury yield spread, and it's by the Federal Reserve, the New York Federal Reserve, the likelihood of having a recession is about 32% by this time next year. And you can see that the shaded areas is when you have recessions. You have 1, 2, 3, 4, 5, 6, 7, 8 recessions. Now, the indicator itself is not 100% true that it was, you know, predicting things perfectly back in the old days, because you can see here this relationship is re-estimated after the last few recessions. So the last one that these parameters were estimated was in 2009, which was when we had the last recession. Okay, so but what's interesting here, if we just assume that these two variables or coefficients were the same throughout history, then what's interesting is that when the actual numbers are about 32, like you've seen above 32, so you've seen here, here, and here, and here, and here, and here, and here, then we have had a recession. Here, though, in what looks to be 1968, that the number went up to 40%, and we did not have a recession. So we can sort of say there's probably a relatively decent chance that in 12 months from now we're going to have a recession. And what's also interesting is that the model itself, it's not that it goes up to 100% when you actually have a recession. In fact, if it just goes up to these levels, you get that shaded area, which means that we probably will have a recession eventually. And if you look at the euro dollar, the last time it was boring was in 2017, and then you had that recession in 2018, and then in 2019 you definitely had a recession. So the market is really boring right now. There's not too much to do we can do about it, but volatility is like at 33-year lows, and I think eventually things will start, and maybe that recession, if we have a recession, that could be something. So don't despair too much. Just need to be patient. This is something I've been doing since 2006 actually, and not all years are going to be very good years for trading, and you just need to remember that you need to keep your money in your pocket and your trading account and trade carefully and not just blow all your money. A lot of people, they double up, they take too high risks, and then that's where they lose because they don't have the money to stay in the game. And if you don't have money in this market, then you're not invited. You need to have money to put up, otherwise you're not invited. You can't take a position. So remember that. Now in the short term, the market is bottoming out. It's trying to go slightly upwards, which is okay. You know, it might go up a bit more, I guess, up to 1365, 114, the way this looks like. But you need to be very, very careful. I mean, maybe buying here. If you did buy at these levels as discussed, then the stop loss goes here. If you just get a 1-to-1, so if we can go up to 113, then you get your 1-to-1, and that's it really. I wouldn't hope for too much more than that. Now this is interesting as well. This is GBP versus the USD, and we had the break to the downside yesterday. We had a confirmed close, and I was short as well for a little while yesterday, but it looked to me that I got in the actual final end of the move, so I closed out that position. But when we look at this today, you know, after a good night's rest, I feel confident that this remains in a downtrend, and I would actually continue to be bearish rather than bullish. It might be a false move altogether, but we're revisiting that breakout point. The way this is looking right now, it might go slightly higher, I think, and maybe to something like 24.87, 25. But as long as you trade below this little area here, I would insist that this is a genuine breakdown, and then we'll see what happens. If we just touch something like the April 2017 low, then that would be a decline of 121 pip, which is quite decent. And if it's a genuine breakout of this, which could be interpreted like a rectangle, it could interpret it like some sort of failed head and shoulders pattern, then we have this target at 119.47. That's something as well I published yesterday. This is the link to my name, or to my profile. I'll send it to you and bookmark it. That allows you to keep track of what I'm publishing here. As you know as well, I am publishing content as well on Twitter, of course, and I do have that WhatsApp list, but the WhatsApp list is just for the videos primarily. For the trading ideas, you would need to come here. Okay, let's move along. Dollar yen. Dollar yen continues to be bullish, and I wouldn't get too excited though, but it is bullish. You're seeing a bit of dollar strength. So Fed's Powell is going to speak today. I think he spoke a little bit yesterday. Didn't really share too much. You know, I think that overall the trend is going to continue to go upwards. We have this head and shoulders. Head, left, right shoulder. We took out this level, triggered here, but it was from this level that I was turned bearish. Was bearish and now turned bullish. Risk reward ratio here, if we go upwards, is 2.92 if you bought on the breakout. We can dip down here, and I think people are going to be buying. Gold prices. I had so much, I was expecting so much about these markets, but it sort of turned really, really boring. Overall, though, the trend remains bullish. There's no real reason here to make any changes at all. I think if we start to trade higher, if we take out something like 1400, we would have stopped to create these lower and lower highs. So when we stop creating these lower and lower highs, we should hopefully trade upwards and sort of trade up into the midpoint of this range. I remain bullish myself, and as long as you're above this level, I'm not going to make any changes. Risk reward ratio here is okay, but the reason why it's okay is also because the actual risk of being stopped out is high. So here is a risk of about $12.72. We've touched the upper end of the range. You have risk reward ratio 2.88, and if we go upwards, you know, the risk reward ratio becomes even better. And if we touch the target, if we assume that this is just a rectangle-like pattern, we can go up here, then EURUSD waters is 8 times the money. And if we go up to 1,600, which we talked about before, then you know then you're looking at 16 times the money. But why is it 16 times the money? It's just because the price is so close to actually touch the stop. Crude oil prices. Okay, so I was bearish from these levels yesterday, and of course this is a free webinar that we do. I do premium webinars for clients, things like that, every evening. I actually said yesterday to everybody there that this market, let's abandon that bearish view, because they did not want to trade much lower. So I said to the guys, let's give this up, and let's see if what happens afterwards. I want to see a break here. If we take out this level, then probably gonna trade lower, because yesterday evening when I do these updates, I did it by 8 p.m. The market was trading here still, around 57.95. It was pretty much the entry for that bearish position. But I was looking at the price action yesterday, and it didn't feel good, so I said let's give that up. Now going forward here, I'm actually just neutral. I want to see what happens on a break to this level, and then we'll see what happens. I think the way otherwise what's happening here is that we're sort of trading within this range, which is just within a larger range, which just makes things a bit difficult. But you have the geopolitical tensions with the US-Iran that could potentially heat up, so the fundamental bias is actually bullish. Okay, this is the S&P, and the S&P 500 yesterday, bottomed out in that buy zone. If you look at the daily chart, you can see here that we had a nice little bullish candle here. This is a bullish candle indicating a low in the short-term levels, and we were looking at this as well from a short-term point of view, and I said that probably down here people are gonna look to buy, and they did buy. I think now we can reduce the trend defining level a tiny bit to these levels here, because I'm thinking if we actually let's leave it, let's leave this stop where it is. But because I was thinking if we trade below here, we can actually trade lower, and then this will be over, because at least in the short term you can see head, left, right shoulder, and as you can probably see, if we sort of do something like that, you get yourself a bearish target. But I'm not gonna execute or do nothing on the base of this low just yet. As for now, the market bottomed out. You have that bullish candle on the daily. The market is just correcting parts of that decline from yesterday. As for the German DAX, it's looking interesting as well. So you might remember a few days ago I said you don't want to be buying up here. You probably want to buy between the 50 and first fib. So obviously yesterday things went quick dramatic, but it slid, bounced upwards, and we're getting that reaction. I have these quite big buy and sell areas because it's very difficult to pinpoint where exactly the reaction is going to be. Sometimes it's not even any reaction. So that's why I have a quite wide area. And then like now, when I can see that the market is stabilizing a bit, I can reduce that trend defining level, because it was down here. Just reduced it a bit. And I'm looking at this with fibs today. And this is the third fib, so there's really there's no real reason here to anticipate this is going to trade much lower. Okay, so we have a question. Asu asks, what about pound yen, and why is pound so fundamentally weak? Why is pound so fundamentally weak? Well, let's begin with that question. It's something I mentioned many times before. It's because of Brexit that people are afraid of what's going to happen in the future. There's one scenario where they manage to negotiate some good trade deals, and that could potentially lead to more customization, because right now the UK goes under the umbrella of the EU, right? Because it's part of the EU. The benefit of being part of the EU is that there is no trade barriers between the countries, and the biggest countries that the UK deals with is in the EU. So firstly, we're moving away from that. So suddenly there's going to be, could be some barriers, probably will be barriers. And then number two, of course, maybe the UK can go back and negotiate deals with the EU. I mean, negotiate deals with the US or other countries which they want to deal with. The problem with that, though, is that the average trade deals take about 7 years to work out. So if we have a no-deal Brexit, it could take some time. Of course, you know, even if, I mean, just Brexit itself is taking, since it's from 2016, this is ongoing. So, you know, maybe they can negotiate something in a short period of time, maybe 3-4 years, maybe. And it really depends on what happens afterwards. Unfortunately, though, the way the market, the world is going, it's going more nationalistic. So, you know, America first, Europe first, UK first. Well, if everybody is thinking, you know, my country first, then I think it's going to be a bit difficult to create any good deals. But we'll see. I'm living in the UK, so I really, really hope we get some really good deals. And we can manage this, but there's going to be huge changes. At the end of the day, as you probably understood, just from this little short conversation here about the realities of this current situation, there's so many possibilities here. You know, you have on one side people being very, very optimistic, on the other side people being very, very pessimistic, and then we just have facts. You know, 7 years of time, that's how it takes. Nationalism is increasing in the world. So there's so many uncertainties, and those uncertainties weigh on the pound. And in the case of the pound yen market is today though bottoming out, and I did actually an article about this, and I'm looking at this today, and there's not too much to actually say about that I didn't say already in this article. So I'm gonna send you this article and you can read it. That way you can hopefully start to read investingcube.com. Now in investingcube.com, not everything is easily accessible, but it's free. A lot of websites don't have that. You go to Bloomberg right now, you need to pay. Some of the other websites where stuff is free, you don't get the quality, you know. You just get a lot of different just spam, really, because pretty much the 3 big websites right now, 4 maybe, but 2 of them, the way they make their money is to sell advertising. So those 2 sites, they just produce loads of content with really no sort of sometimes no substance, because they just want to show you the advert, and then the guy that actually wants to advertise, they can say, look, I had a million people watching my website last month. You know, if you want to show your adverts, you're gonna reach 1 million people. You know, this is the price. So a lot of the content is a bit bad. Now there's other websites like the one I used to work for, ATFX. It's a great website. Fortunately, they move really, really slowly. Content is not really updated frequently, and so that's not really that useful. So we try to be somewhere in the middle, where you can get some useful content relatively quick. Not as quick as many of the other websites, but many of the other websites, again, they're just gonna put a fancy headline and that's it. So we're in there in the middle, and it's free. It's free to join, but you do need to register. So what I suggest, click on that link. If you're not a member already, if you're a member already, just sign in. If you're not a member, just click on it and you become a member. Then you can access all of that content. And I can tell you right now already that the quarterly report is done. We did it already 1 month ago, but it's still worthwhile. We wrote it 1 month ago, but it's still worthwhile watching it. We have that PDF. So that PDF is going to come up by the end of the day, and that as well is like a perk you get access to here by being a member of investingcube.com. So, sir, I suggest you read that article, and if you have any questions or anything at all, just reach out to me. Have a good day, guys, and I'll see you guys tomorrow, and don't forget to like the video. Bye-bye.